Facing one of the worst inflation episodes in history required the implementation of drastic measures that triggered a banking crisis, which would amplify amidst a period of misguided policies and result in the highest number of bankruptcies in the history of the United States since the Great Depression. This is the story of the 1000 Banks Crisis. Savings and loan banks, known as thrifts or S&Ls, are institutions that emerged in England in the late 18th century as non-profit cooperatives aimed at providing a social good by helping their members purchase their own homes. In broad terms, savings and loan banks operated similarly to traditional banks. They accepted deposits for which they paid interest and primarily lent these funds for mortgages at higher rates, using the difference to cover their operations. During the 19th century, urban growth in the United States increased the number of these banks, but it also changed their nature to become private and profit-oriented institutions. Like many financial institutions, these banks encountered serious problems during the Great Depression and became subject to stricter regulations. One of the main changes was the limitation of the interest rates they were allowed to pay on deposits, as many of them had significantly increased these rates to attract deposits from their competitors. However, in order to make money, they had to engage in riskier practices with higher expected returns, which were not always achieved. These practices were also prohibited, and the investment possibilities of these institutions were limited. The Federal Savings and Loan Insurance Corporation was established to insure deposits up to a certain level in these banks, reducing the risk of bank runs, which occur when many people withdraw their money simultaneously, leaving the bank without sufficient liquidity to respond. Additionally, the Federal Home Loan Bank System was created to provide liquidity to these institutions. After World War II, the expansion of the middle class in the United States allowed these institutions to thrive, and a large number of families were able to own their homes. However, due to regulations, these banks maintained a low level of growth, and what had worked for several decades would no longer be successful in a scenario for which they were clearly unprepared: the Great Inflation. When World War II was coming to an end, 44 countries gathered in Bretton Woods to agree on the new monetary system that would operate now that the classical gold standard had come to an end. The main agreement was that the dollar would be backed by gold at an exchange rate of $30 per ounce, and any country with dollars could claim this gold. What initially worked well and provided great stability to the system began to have problems when the United States incurred large budget deficits due to the different wars related to the Cold War, the space race, and domestic programs like the Great Society. In addition, there were large trade deficits as the world finished rebuilding after the war and international trade increased. This ultimately led to the creation of a large amount of dollars that did not have enough gold backing them, and with these gold reserves rapidly declining because other countries continued to exchange dollars for gold. This led Nixon to announce the end of the gold backing of the US dollar on August 15, 1971, and the country entered a deep inflation that was further amplified by the energy crisis of the 1970s. This inflation required extreme measures by the Federal Reserve, which found one of its best presidents in Paul Volcker. He focused not only on raising interest rates to a record level of 19% in 1981, but also on restricting the amount of money in the economy by increasing bank reserves. Although this monetary policy achieved its objective, it caused 2 periods of recession in the United States. The first was from January to July 1980, and the second was from July 1981 to November 1982. It also resulted in one of the worst banking crises in the history of the United States, which, until now, is only comparable to the Great Depression in terms of bankrupt financial institutions. When the Federal Reserve began raising interest rates to combat inflation, the assets of institutions like savings and loan banks, which mainly consisted of mortgage loans and long-term treasury bonds, began to lose most of their value. Additionally, with the increase in interest rates offered by other options, these banks experienced a huge outflow of deposits, prompting President Jimmy Carter to approve the DIDMCA in 1980, which allowed these institutions to increase the interest paid on deposits. However, by 1982, these institutions were experiencing annual losses of $4 billion, leading to the depletion of their capital and to insolvency. And because the Federal Savings and Loan Insurance Corporation did not have sufficient funds to cover depositors, these institutions were allowed to continue operating in the hope that the market problem would be temporary and they could eventually recapitalize. But the situation would worsen in 1982 when Ronald Reagan approved the Garn-St. Germain Act, which allowed savings and loan banks to engage in a wider range of investments, merge with commercial banks, and operate with lower capital. This radically changed the business model because, in order to compete with other banks, they raised interest rates on deposits and attempted to sustain them with riskier investments. This also created a significant moral hazard for these institutions because after losing most of their capital, owners and executives faced no personal risk and could speculate with their clients' money, taking on even riskier behavior thanks to the new regulation governing them. If they were successful, they could make a lot of money, and if not, it would be their clients who would suffer the loss, most of whom were backed by the government anyway. As good bankers, they did not miss this opportunity, and although initially these measures served, at least superficially, to increase the assets of savings and loan banks by 50% by 1985, many continued to fail and go bankrupt. And in 1987, the Federal Savings and Loan Insurance Corporation declared insolvency, and the federal government had to recapitalize it, essentially financing the speculative behavior of these banks. They had transitioned from using their clients' deposits to make mortgage loans and help fulfill the American dream to engaging in a series of risky ventures with a low probability of success, clearly demonstrating their lack of capacity to manage such endeavors. But the problem did not end there. Speculative behavior turned into fraudulent practices. In broad terms, it worked as follows: a person would purchase a property, an appraiser would significantly overvalue it, and a third party would apply for a loan based on the inflated value of the property, purchase it, and then default on the loan, pocketing the difference between the inflated and real prices as profit. But before telling you how this crisis ended, I want to invite you to a free 30-day trial of Audible, where you can explore thousands of audiobooks. You can access it through the link I will leave in the description. To address this crisis, Congress passed the Financial Institutions Reform, Recovery, and Enforcement Act in 1989, which re-regulated these institutions, limited risky investments, established minimum required capital equal to that of commercial banks, increased deposit insurance premiums, and eliminated the Federal Savings and Loan Insurance Corporation, transferring insurance to the FDIC, which has been responsible for insuring bank deposits since the Great Depression. It also created the Resolution Trust Corporation to liquidate failed financial institutions. By the early 1990s, the banking crisis was subsiding, but not before the Resolution Trust Corporation had liquidated over 700 savings and loan banks, with over 1,000 total failures, resulting in costs of hundreds of billions of taxpayer dollars and contributing to the 1990 recession. This banking crisis went through 3 recessions and lasted for over 10 years, making it one of the longest in history. Unfortunately, it would not be the last of its kind. Budget deficits, excessive money creation to cover them, inflationary pressures, and the need to raise interest rates to combat inflation would become a recurring cycle, leading to losses in bank assets, uncertainty among depositors, and bankruptcy or risk thereof for many of these institutions. Does it sound familiar? I hope this video has been helpful to you. If so, you might want to watch the next one. See you next time.